They've said for 2 years we're going to go into a recession, never have gone into a recession. If you look at the numbers, just a week ago, GDP is up, unemployment is down. You've got the current administration that just passed this big, beautiful bill, tax incentives that are helping guys like you and I with cost segregation and bonus depreciation and buy more real estate, right? It's going to put more cash in your pocket, keep you a little bit more liquid, and it's going to help you build longer term wealth.
What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. I've got a really interesting guest episode for you guys this week. In this episode, I'm interviewing Mike Morawski, who is a longtime real estate investor and someone who's got quite the interesting story. And I want to just give a little bit of a disclaimer at the top. This is an interesting episode in that Mike has battled some pretty significant business challenges that became real tough personal challenges. And we get into that in this episode. And it's a little bit of a deviation from the normal content here on the podcast feed. And to put it, simply at a high level, Mike is a longtime investor who got a start in construction and then started syndicating multifamily deals back in 2005. Grew a very large portfolio between 2005 and then the market crash in 2008, 9, 10. And, we're talking over 4,000 units, 100 employees in his business. And then he went to zero and he lost it all. And along the way, he got into some very severe legal trouble just through some charges through wire fraud, mail fraud, etc., and ended up doing a pretty lengthy stint behind bars. The reason that I wanted to have him on the podcast and record this episode was because one, he had a very unique perspective in that he rapidly grew a very large real estate business during a time of where, a lot of folks were obviously growing large businesses at that time. And he's uniquely qualified to share some pretty heavy experiences in terms of the mistakes that he made and the decisions that he made at that time that I think are really interesting for the listener to listen to and to hear and to maybe learn from. And we talk about how that crash compares to what's happened over the last few years in the multifamily market. We talk about, what his focus is now. He's basically fell from the top of the mountain and has atoned for some pretty significant crimes and has crawled back to the top being totally relative here, but has gotten back into the real estate business and is doing large multifamily deals again. And I think he's an interesting guy and we have an interesting conversation. This is by no means an endorsement, the recording and the release of this episode for the decisions that he made. He paid his debt to society. I think there's a lot that can be learned from here. And I think that regardless of the decisions he made, there is still content in this podcast episode that I think is really interesting for folks to listen to and to learn from. And I also think that he's somebody who can talk about market cycles, given that he experienced a couple of them. And even before he got into syndicating real estate, when he was in the construction business, early 2000s, late 90s, same situation, right? He experienced one back then. So interesting podcast episode that I think most of the listeners, all the listeners should really enjoy listening to. And if you do listen to, or I should say, if you do enjoy listening to this episode, please leave the podcast a rating and review. Coming up on 300 episodes on the podcast and would love to eclipse 300 reviews before we get to that 300th episode. So if you've learned anything along the way here listening to the show, please consider leaving the podcast. Just a quick rating, takes no more than a few seconds. But without further ado, let's get to this episode with Mike Morawski. As you just heard me talk for a few minutes here about this upcoming episode, I am very excited to welcome Mike Morawski, who is a long-term commercial real estate investor. Done a whole bunch of deals, 450 million plus in transactions. Currently the managing partner of Resilience Equity and founder of My Core Intentions. And in this episode, we're going to be getting into growing your real estate business, dive into how we can navigate changing market conditions, and some fun topics as well. So looking forward to our conversation here, Mike. And why don't you give the listeners a little bit more of a backstory on yourself, how you got into the real estate business way back when, and what your business looks like today.
When you say things like way back when, it makes me sound old. You know that, right?
I say that about myself, and I've been in it for 9, 10 years. I call way back, mid-2010s are way back when to me now. So I guess I use that term loosely.
Yeah, it's kind of funny. But hey, I appreciate you having me on. And I've been excited about being on this show. So, Mike Morawski from Huntington Beach, California. I actually lived in Chicago forever and moved out there a couple of years ago. Always wanted to be out there, go out there 3, 4 times a year on business and said, I'm always going to live there. And you and I were talking about it before the show a little bit. You can't beat the weather. So,
You can't, that's for sure.
but
Different than Chicago in about every single way, I would imagine.
absolutely. Yeah. Been in the real estate space about 30 years. Started out, I had a general contracting business building residential room additions and built about 25 a year for about 8 or 9 years and burned out on it. And just got tired of that business, and went into the residential real estate sales business. I built a team pretty quickly. We sold about 125 houses a year for about 12 years consecutively. 2005, I had seen the market starting to shift and soften and knew I would have to go do something different because I wouldn't keep that production up, and always wanted to be in the apartment business. And, it wasn't I just woke up one morning and said, oh, I think this will be a great idea. But I had done some work for a couple of apartment syndicators in the Chicago market when I was in the construction business. And I understood the model. You go raise private money, you marry it with a great real estate deal, you stay in the middle, and as long as everything goes well, people do well. And 2005, I syndicated my first apartment deal and went on from there over 30 months to buy 4,000 apartments in 5 US markets and build a property management company that managed 7,500 units in those markets and built $100 million company.
Wow. Yeah, I mean that is a lot of growth in a short period of time. And I know we're going to talk about market cycles and maybe some things that investors need to be mindful of in terms of investing when the market's shifting, et cetera. And I'm sure we can probably draw parallels in terms of what happened between '05, 2010, and that stretch to what's happened the last few years, especially in the Southeast, Southwest. Maybe talk about your experience post-market crash back in '08 and that time frame, and then I'm probably going to have some follow-ups as it relates to maybe how that compares to what's going on today.
Yeah, so I built that company in between 2005 and 2010. And I always tell people I made 5 mistakes along the way. One being that I grew too fast. You mentioned it, right? I mean, that was the first thing you said. And, I don't believe that anybody should scale a business that quick. Matter of fact, this is my second round, and I'm taking my time. I was over leveraged. Mistake number two, I owned $60 million worth of real estate at 85% loan to value. This is back, the banks are throwing money at you, investors were throwing money at you. It was crazy. And then I was undercapitalized as a business owner. And then the fourth mistake was, and I say that I was undercapitalized as a business owner. I had 100 employees working for me and figuring out week to week how to make payroll. And then the fourth mistake that we made was that we didn't pay attention to the details. Everybody talks about asset management today, but a decade ago, people didn't talk about it. It wasn't as prevalent as it is today in coaching circles and platforms like that. But asset management is so critically important to what we do. And the fifth mistake was that I didn't listen to people around me who were instrumental in my life, who pointed things out that I didn't see on my own, and I didn't listen to them. As a result of all that, and here I always tell people, I say, I never flew private. I never lived in a big house. I didn't have a fancy car. I was the neighborhood baseball coach, home most nights for dinner. Wound up getting in trouble because our assets got so upside down that what I tried to do was move money from one company to another to keep them afloat. So I had 38 different companies. Some were very profitable, some were not profitable. And I take capital from the profitable companies, move them to the non-profitable ones. And my accountant and attorney both said it's okay to do that, leave a paper trail. But I didn't tell my investors of the movement of money. And for non-disclosure, I wound up getting charged with wire fraud and mail fraud charges and got sentenced to 10 years in federal prison. So totally got wiped out, lost everything, and learned a valuable lesson along the way.
Yeah, no, I mean, I think that first of all, I appreciate you running through those 5 mistakes. And I think that there's probably some listeners who have bought some deals, whether it's the scale to which you grew your operation at that point in time up to 4,000 units and all of the employees that were in house there, or even just at a smaller scale where they could probably relate to some of those, right? Growing quickly can mean different things to different people. And, even just the individual investors who are not raising capital from LPs, it's still easy to do that where you get into a number of projects, you don't have enough money behind you in the bank to fund the renovations at property A while you're putting deposits down to pursue property C and this new deal and what have you. And I relate to that. Just that was, my foray into the business was just using a lot of debt from 2015 to 2020, buying these small deals and stretching dollars really thin.
Yeah.
And I think a lot of people find themselves in that situation, and I think I want to drill a little bit more into maybe a couple of these, but the first one that comes to mind because I think it's a little bit, or it's less discussed, I think, than the other ones. Obviously, using high LTV debt, everyone has the mental correlation of, okay, more leverage equals more risk and growing too quickly, et cetera. But I think being undercapitalized is a less frequently discussed topic as it relates to something you really
Mm,
need to be mindful of. Because I think that there's a perception where if you get the debt right, I'm only using 70 LTV on this deal, I should be in no trouble. You still need cash behind the scenes to fund issues with a business plan or to help continue growing the business, making hires, making investments into the different components of the business actually allow you to grow. And real estate's being very capital intensive can pull chunks of that at different times. So that specifically as a mistake that you've made that I'm sure you've learned from, what do you do differently now? And maybe what decisions are you making behind the scenes to make sure that the deals that you pursue are capitalized correctly at this point in time?
Yeah, I think a couple things that really stress deals in today's environment and the point of the market cycle we're in. One is that if you can't execute and completely raise all the capital you need to execute your business plan, you're gonna find some challenges along the way. Part of that capital raise is generally raising capital where you're going to have operational funds sitting on the side for a period of time till you get to stabilization on an asset or beyond even. And if you don't have that capital sitting on the side, again, you're in a situation where you don't have enough operational flexibility in the property as a result of that. So I think it's really important to make sure that in your underwriting that you have good capital reserves built in and that you are able to execute and get all the capital for the deal raised that you need to have raised.
Yeah, no, 100%. I think that especially for folks who are buying value add deals and maybe their lender is loaning funds on construction, it's like really easy to raise the amount to get it closed. Maybe, you have some reserve capital there and you're like, oh, well, my bank is going to be lending me the funds for the renovations or what have you. And they're still raising the bare minimum. And then, yeah, you have to front the renovation costs and you got to wait for them to reimburse you. And maybe there's a snag in that process. And, if there's truly no buffer there in terms of closing a deal with the bare minimum of the capital required to close, you're setting yourself up for problems. Or even if, you're not dealing with problems at the bare minimum, a lot of stress as you go and actually
Right.
work through that business plan. I know we just talked about kind of mistakes that were made during that time period, but something that I'm curious to or for you to reflect on is maybe what went right in that time period. Obviously, it still takes a lot of work and a lot of correct decisions to buy that volume of real estate over that period of time and to keep your arms around it to the extent that you did, maybe before you had some challenges. If you were to reflect at that period of time in terms of like, these were decisions that I made that in retrospect were actually the right decisions, do some come to mind?
Yeah, so a couple of the hires that I made were very instrumental during that time. One person that comes to mind right away is an assistant that I had that worked for me. And she actually had worked for me when I was in the residential real estate space. And when I made this transition, continued to work for me. Wound up started as my personal assistant, but from there wound up being, a director in our company that kind of handled all of the moving parts, right? And, everybody has a job function in what they do, whether you're on a team or you're an employee at a company, everybody's got a job function. And she had the ability to handle things and remember things and get things accomplished that just some other people couldn't get done. And it was a strategic hire. Another strategic hire I made during that time was the fact that we had a woman working for us who was an account representative, and she handled all of the investors. So I think one of the challenges that comes up in capital raising, and we all know we're a function of capital, right? And this is one of the biggest parts of our business, is that we have the ability to raise capital. But she was an account manager, and she stayed in touch with all the investors, and she made sure paperwork was done, and she made sure that funding was done, and that the connection between self-directed IRA companies and investors was all completed. I think those were a couple of the really strategic hires that I made that were smart moves. But there were a couple of properties that I bought that were always cash flowing. And they were a couple of those great assets that didn't get sold till years later, after, we had lost everything, that just continued to provide cash and continued to make investors whole, and to help what was left of that company come out of the rubble from it, really.
Hmm. And were those properties that performed well, do you think it's because they were in a specific market that may have been different than the other markets where you maybe had more challenges? Did just buy them at the right prices, or were there some other attributes there that made them better deals?
I'm gonna say something right now that a lot of people might find controversial. I have always been a market-driven investor, and I bought a couple of those two or three deals that I'm specifically thinking about were deals that were in tertiary markets that most investors would say, why would I want to buy out there? I bought a deal in the middle of a cornfield that threw off more cash than any other deal I ever owned. I think it's sometimes thinking outside the box and doing things that, Warren Buffett says, when people are not doing anything because they're in fear, you should be doing something. And people back then were not considering tertiary markets, and I was. And so, I'm not a genius, and there's no geniuses in this business. There's only market cycles, right? So,
Were they, Southeast, Midwest, like where I guess geographically in the country you're talking here?
two were southeast, one was in the Midwest, one was in a 30 miles outside of Indianapolis in a cornfield. And the reason I bought that deal was because Walmart was building a super Walmart across the street. And
Hmm.
I knew that would bring some growth to the marketplace, which it did. And then the other two, one was in outside Huntsville, Alabama, and Decatur, which, Huntsville at that time had just started to really become a market to buy in. And if Huntsville's one of those markets that you look at today, you'll know why.
Hmm.
It's continued to be a great market for the last, decade. And then the other one was in Dallas. And Dallas has always been a really good market to buy in. But this was way outside of Dallas. And everybody was like, the growth will never get there. And the growth got there. So,
Yeah. It sure did, especially in Dallas. Yeah. Now, something that I'm interested in too is comparing maybe the similarities and then maybe the things that aren't so similar around what happened in 08, 09, 2010 as the market started to crash to what's happened the last few years. I think setting the stage, right? There's overzealous lending in both cycles, right? But I would imagine there's maybe some nuanced differences between the two. Like last
yeah.
few years, floating rates jumping up, people just, not underwriting that and maybe not buying the appropriate rate caps and stuff like that. I know supply was a big dynamic, a whole bunch of new apartments being built, which drove rents down. But what are some things that are similar between what's happened between, call it, late 22 when rates started to run up and now versus, the crash back in 08?
Yeah, liquidity. There's a
Mhm.
lot more liquidity in the market today than there was back then. The crash in '08 happened because of the residential market and the under liquidity. People were over leveraged. You could walk into a bank and get 125% financing. If a home was worth 100,000, just for simple math, if a home was worth 100,000, the bank could give you 125. You could do two loans at the same bank, an 80 and a 20, and never put any money down. So again,
Yeah.
it was an equity issue, right? There was no liquidity. Today there's liquidity. You got interest rates. You have people that live in homes today that were valued at 3%, or their interest rates are 2% and 3%. They're not moving. So people are sitting on liquidity, and they're sitting on home prices that have gone up in value in the last few years because of the supply and demand piece in there. And it's a different world. Back then, people had no choice. They couldn't come out of the hole. Today, people aren't in a hole. They're just sitting on the sidelines, you know.
Mhm. Yeah, I mean, it's if you look at like any data or any graphs of like average homeowner equity in 2025 versus 2008, like it's two totally different numbers from a single family home standpoint, right? And I think that that's a huge point. And, while cycles are consistent over a long period of time, and part of me is talking out of my ass because I've only been involved in the most recent one, but when you look backwards, it's like there's the same ebbs and flows, but there's also slightly different reasons as to why each cycle occurs. I think COVID stimulus driving insane pricing, rates being slashed, and the corrections that needed to occur because of the mania that resulted from that is driving a lot of what's happened here in the last, call it, few years. But what I think is interesting is I'm up in the Northeast, you're out on the West Coast. You've bought in numerous markets throughout the country. The vast majority of our real estate businesses holdings are in New Hampshire, right, an hour north of Boston, which is a Northeast market that hasn't really seen any price reductions over the last few years in multifamily or single family housing either. I'm an LP in a handful of deals in Texas and Florida, which is the complete other end of the spectrum, right, where pricing has started to come down at varying levels depending on the market. I'm not privy to what's going on the West Coast. I don't even know if you actively buy out there, but I'm interested in your take as it relates to what you see as the path forward here the next few years in terms of we have two different kind of stories in the market, right? You kind of have the Midwest and the Northeast that have been far less affected with what's occurred over the last few years than what's happened in the Southwest and Texas and this in the Southeast down in Florida. Have you, one, I guess, have you noticed the same thing? And two, what do you think is going to happen over the next few years in terms of how are you making decisions with the information that you have today in terms of where you're investing and the markets you may be investing in?
Yeah, so I think people need to quit listening to the news. Well, let me back up for a minute. First of all, I don't invest on the West Coast. I think it's overinflated, but I'm also only a red state buyer, right?
Hmm.
Because of the landlord tenant laws, right? So that's one, point that I wanted to make. But I think that too many people listen to the news and what the news dictates. And the news is saying right now, that it's bad, right? I mean, that's the simplest way you can do it. And I haven't watched the news in almost 6 years, but here's what I know. By the time it catches up with CNN and they start to say, oh, the market has changed and there's, people are buying houses and the resident, because so much is spurred on by the residential market and people are buying houses and interest rates have come down. By the time CNN starts saying that, it's too late. It's already happened. So I firmly believe, just based on watching history and where we're at today, we're at the bottom of that market cycle. And we're probably starting to move out of the market cycle into the next phase, or the first phase of the next up cycle, because these cycles are in 4 phases. And you can see based on those graphs that, hey, we're at a place right now where things are starting to go back up. They've said for 2 years we're going to go into a recession. Never have gone into a recession. If you look at the numbers just a week ago, GDP is up, unemployment is down. You've got the current administration that just passed this big, beautiful bill, tax incentives that are helping, guys like you and I with cost segregation and bonus depreciation and buy more real estate, right? It's going to put more cash in your pocket, keep you a little bit more liquid, and it's going to help you build longer term wealth. The other thing that's going to happen, I believe, from this point in time, within the next 6 months, we're going to see interest rates come down. I believe early next year, we're going to be below 6 on the interest rate spectrum for retail. And that, once that happens, the market's going to explode. And I'm telling people today, whether they're my passive investor or they're an active investor that wants to get in the market, to take advantage of where we're at now. Go out and buy something, even if the interest rate's a little high and it causes a little bit of a challenge by the interest rate being high. You're going to be able to refinance that within the next year. Just structure your loan to be able to do that, and then take advantage of as we go into the next market cycle, because the wind is going to be at your back here, and we all know what happens when the wind's at your back. It makes things a lot easier, and you'll cycle up. I believe in this next cycle, there's going to be, a whole new host of millionaires made. And it's just a matter of who they are going to be because they participated early enough. I can tell you 3 times in my life, I've said, boy, if I could have just got into that before the market changed, before the market shifted, and I could have had some assets, I'd be in a different place.
Mm-hmm. And I'm interested to hear, kind of how your thought process around evaluating and underwriting deals maybe has changed. I was going to go all the way back to '08 when you started buying, but that's probably too far back and there's probably been too many changes. But let's just even say 2020, 21, 2022. When you were looking at deals, what did you prioritize? Maybe, I don't know if there's specific underwriting metrics or data that you're looking at. What kind of defined a good deal for you? And has that changed over the last few years? And, moving forward in terms of what you're looking for right now and the types of deals that you're looking for today? Or is it still relatively consistent in terms of what you're actually looking to buy within the real estate business?
Yeah. So one thing is I need to be in a positive yield position. I can't be in a negative yield position starting out. So even if it's a 25 basis points, right, difference, I still have to be in a positive base or position. I
And
have
you're
to look at
and I'm sorry for interrupting, but you're just saying like entry cap rate, the cap rate the day that you close versus your interest rate in terms of,
correct,
gotcha.
correct,
Yeah.
correct. Even if it's just a slight difference, it still needs to be different, right? The other thing is no rent growth year one. How's that deal work with no rent growth year one? Because what happens if rents do slide a little bit and occupancy slides? I need to be able to still be able to function in that environment. I'm probably penciling more of an economic vacancy factor today than I would typically. So instead of maybe a 5% vacancy, I might be penciling closer to 15% today, just to make sure that I've got some space. My loan to value, 65% is a place that I start with. And, if I go too much above that, I won't go above 70, but I need to have that equity tranche in the deal. And those reserves, I need to be able to have that money on the side when I close on a deal, just in case there does show up a storm here in the last part of this cycle. So I think I've always been kind of a conservative underwriter, but we'll look at the data. And the data may say, hey, rent growth for the next 8 quarters is going to be 3.5%. Well, I'm not going to underwrite my deal at 3.5% rent growth. I'm going to underwrite it at 3%, right? I'm going to stay under what the projections say, just because, projections are just that. They're just projections. And these groups that bring deals to the market that are showing high IRRs on deals where rent growth is 4 and 5%, I, you know, I don't know that they make sense to look at.
No, I tend to laugh when I see somebody bringing out a deal, especially in a Texas or a Florida market with all the supply that's still being absorbed, where it's like big rent growth number year one. Like that's a really overzealous assumption to be making. And but as you said, right, they're projections, and you do the best with the data that you have, but at some point you have to look at the reality of the situation that you're probably in some of these markets where still continuing to build, there's still all this competing supply, they're still doing all those lease up incentives to where we have to understand that we're going to have a little bit more vacancy. We're probably going to have more turnover because we're still turning over more units because there's still people that are going to leave because they're going to get 2 months free down the street. And it's important to at least underwrite that over the next couple of years. And it's a little easier to project over the first year or 2 years in a hold period because there's all kinds of data to still look at right now. That said, from a market selection standpoint, are you still pursuing the deals or still pursuing deals in the same markets that you were back when you got into syndicating deals back in 2008, 9, 10, or different focus now, and how's that evolved over the years?
Yeah, probably a few more markets, pretty much the same though. I've always, you know what, I've never really been a super northern buyer. I don't care for snow and I don't
Yeah.
want to deal with snow on my properties, right? So we look in the southeast. We monitor about 40 submarkets, so three or four markets in Tennessee. We're pretty heavily vested in the Tulsa, Oklahoma market, Northwest Arkansas, Dallas, Florida, Alabama, Georgia, the Carolinas. So, kind of traditional. Now, I know there's some other markets around the country. For whatever reason, today, Pennsylvania is unbelievable as a market. But I personally, I don't have an interest in the Northeast. So
Hmm.
I'm a Southeast, lower Midwest guy. And that's really what we look at. And here's what's interesting, too, is deals are starting to pencil a little bit more right now. Like 3 months ago, when I have a coaching program and I've taught people, how to underwrite, and I have coaching clients that are in these markets underwriting these deals. And, we're looking at, I might look at 3, 4, 5 deals a week with coaching clients. And, what's happening is deals are penciling better. So now it's a function of, hey, can we raise the capital? Can we go raise 5, 6, 7 million dollars on a deal today in today's environment with, investor sentiment still being at where it's at? So
Hmm. And when you say, I kind of want to dig into that a little bit more. So when you say penciling now comparatively to maybe just a few months ago or last year, just are you talking pure price points in terms of deals are willing to trade at a price unit at a cap rate that makes sense? Are you seeing rents start to pick back up and that allows it to pencil a little bit more in your projections? Or what do you, I'm kind of digging into that a little bit more in terms of what you're seeing, like deeper discounts to maybe the last price that it traded at, and we're starting to clear some of these transactions that maybe were struggling with debt, and now sellers are becoming more realistic and more willing to have conversations.
yeah, so I'm seeing pricing come down, not so much growth in expense or in rents, but I'm seeing pricing come down. And I think sellers are a little bit more realistic today or need to get out of deals because it might be a bridge loan or some type of floating rate debt that's killing them. And so they're bringing pricing down. So I think things are on sale today and the sale is getting better. It's like Walmart with the flipping of the price, right, on the
Yeah.
commercial. It's the same thing. But we looked at a deal in Dallas last week that there was a 200 basis point improvement on the investor yield that the investor would be able to get today versus when we looked at this deal 8 months ago.
Hmm.
So the deal was on the market 8 months ago. They brought it back to the market recently, 200-point difference. So when I bring a deal to the market, I want my investors to be able to achieve a upper teens return with a upper single digit cash on cash. And, it's hard to do that where cap rates are at, interest rates are at, insurance costs are where they're at, unless the pricing comes down on the property. So,
Yeah. No, 100%. In terms of actually keeping your arms around the whole beast right now, I know that you mentioned back in '08 a mistake being kind of growing too quickly, a lot of moving parts, details, getting lost, etc. What does the infrastructure in the business look like today in terms of how you're managing assets that are in a number of different markets? I'm going to guess you're using third party, or do you have management in house? And what does the business look like now to allow you to keep a better eye on how all the assets are performing and to be a little bit more diligent there?
yeah, so there's a big difference between property management and asset management, right?
Yeah.
And I think that there's a disconnect there for some people. But you got your property management in place, and you might have an asset that you have staff on, and you've got, maintenance, and you've got leasing or management, and you got to watch those people. This is a people business, and unless we're staying on top of it, And I'll give you an example. I had a phone call this morning with the owner of a property management company that manages some of our assets. And I said, okay, we need to get a few more leases in here. Or a few more units rented. Where are we at in the funnel? And he was like, what do you mean? I said,
Yeah.
well, if we don't have people coming to the website, filling out a guest card to go to application, you have to have leads coming in, tours being done, applications being filled out to getting qualified tenants to get your move-ins, right? So that's the funnel structure. Well, if we only have 37 applicants and we only have one possible move-in as a result of 37 people that dropped in the top of the funnel, 37 came in the funnel, 4 applications, 1 got approved, 1 move-in. Those aren't good odds. So I have to increase my inflow into the funnel. So how do we do that, right? And I think there's a number of different systems and marketing strategies out there that you can use to fill the top of that funnel. But that's one of the things on the asset management side you have to watch. Everybody thinks that it's just occupancy and finances, but it's beyond that because you got to drive the traffic, right?
hmm So, in summary, it seems so working with third-party PM companies, and then you guys are diligently managing them at the asset management level. And what does your team look like in your office now? You mentioned that you're on a call and having those conversations with the PM that's handling the management of that particular asset, but what other type of help do you have right now, and what does the organization look like?
Yeah, so I have a full-time underwriter that underwrites deals and does due diligence when we do decide to go to a deal. Most of my deal structures today are partnerships. It could be that I partnered with somebody who was in my partnership program, my coaching program. I do have a full-time partner in our company, Resilience Equity, and her and I, do asset management together. She's a great partner. She's like my right hand and handles all the compliance stuff, right? Investor paperwork, your legal stuff, financial stuff, insurance, marketing, that kind of stuff, and frees me up to look at deals, underwrite deals with my underwriter, and to be able to do acquisitions as they come up and spend a lot of time raising capital.
Yep.
So
No, that's great. This is just almost a selfish question myself. I mean, I'm in the process of continuing to hire at like the investment company level on the underwriting side, acquisitions, et cetera. I know there's a lot of folks listening to this, as we talked briefly before we started recording, who are looking to grow their business and above and beyond maybe just raising money, but actually building their team. If you had, and I know we could even reference the time when you grew the organization back in '05 throughout 2010, and then obviously this last run here. Let's say I'm going to kind of paint a scenario and then I'd like your thoughts. You're an investor who's probably tapped out in terms of you've got so much stuff going on. You're chasing the deals, you're underwriting the deals, you're raising the money. You're also the person who's asset managing everything, a few hundred units, maybe a number of deals, and you're starting to get spread pretty thin. What would you recommend as the first hire for that person, or how should they think about making that first hire as they continue to grow their team, or not continue, but as they look to start growing their team?
well, I figure out what they need first, right? What are your
hmm
absolute strengths and what else needs to be done, right? So, what do you absolutely need to do yourself? What could somebody else do? Then I would put in place 1 or 2 virtual assistants to help me with some of that other stuff, right? I have a complete team of virtual assistants that help me in my day-to-day business as well as on the property management side. We have virtual assistants on property management that help with new tenant applications and marketing and processing and paperwork and things like that. So I think a lot of things can be done today to lessen the workload on you as the visionary, as the rainmaker, as the driver of your business to take off your plate. It's like you shouldn't be cutting your own grass or cleaning your house. You should have somebody else doing that stuff. And I don't necessarily mean your wife or your husband. I just mean somebody else. And so I think that it's first of all the people around you to help take some of the pressure off of you individually so you can think clearly about your business and where you want to take your business. Then the next hire could be an underwriter. The next hire could be an asset manager. Depends on what you're best at. And I'm hoping you're best at raising capital, because that's where you got to be out building those relationships. And those relationships are hard to build if you have all this other pressure. So you got to relieve the pressure in order to function and do what's best for you.
Yeah. No, I mean, it's a great point. I think a lot of people, I think, are trying to outsource or delegate like the critical functions of the business, which is like finding deals and finding money, and it's like you kind of have to start in the other components of the business first. Ideally, you're starting personally, as you mentioned, right?
Right.
You should be help with the lawn or help with cleaning or all of that stuff where it's like buy some of your personal time back that you can just invest in the business at a high level. And then it's like, what do I need to be involved in as the business owner? And let's just define all of the work that can be done by somebody else where it's a little less critical to the success of the business and at least start there. So I think that's great advice. Well, we're coming up on our time here, Mike, and I want to make sure that you give everybody an opportunity to learn where they can reach out to you, get in touch with you. First of all, great episode. And I think a lot of the folks who are listening are going to be taking away some of those big mistakes that you made, but also trying to figure out where the opportunity lies here over the next 4, 5, 10 years as we enter ideally this next stage of the cycle, hopefully somewhat sooner than later, I think, for a lot of the folks who are listening.
Yeah.
But great stuff here today. And where can folks find out more about you?
Hey, can I just take 45 seconds here and say a couple things?
Absolutely. Yeah.
First of all, I appreciate you having me on the show. Thank you. And I hope that your listeners picked up one or two golden nuggets. And when a lot of people think, oh, my life might have been over because I went to prison, and I did serve 8 years behind the wall. But during that time, I reinvented myself. And people would think, oh, that's the end of him or the end of the story. And it wasn't. I think there's a redemptive piece here where when I was in prison, I went to college. I got a bachelor's degree in theology. I wrote a couple books. I wrote a paper that got published in the Business Journal of Ethics that gets taught at the collegiate level today for forensic accounting and sales and marketing classes. I was on an outreach program. I went in the community. I told my story. And I tell my story today because I think people get stuck in their own past history and think they can't get out or move forward. And I hope that the point I make for people is that you don't have to stay stuck, that you can go on and build a new life. I came home and thought I was going to go into coaching and training business, which I did. And, that was all I would do. But I wound up finding a deal, had a securities attorney go and get me approved by the SEC to go back, be an issuer of securities and a sponsor of deals again. So I feel like everything has come full circle. And I just want people to know that you don't have to let your past define your future and that you can move forward. So thanks for letting me say that. And,
Of course. No, I'm glad you did because it's impactful and it's important. And I think it's great that you own that and lead with that as part of your story as well, because I'm sure a lot of folks are going to resonate, whether it's a similar situation or something, outside of maybe real estate that's given them some challenges and maybe kept them back. I think that there's probably going to be a lot of folks who resonate with that.
Yeah, thank you. Yeah, where people can find me is anywhere that you hang out on social media. I'm there, whether it's LinkedIn, Instagram, Facebook. You can go to my page and either DM me there, or I love to network with people. People can reach out to me directly by email, mike@mikemorawski.com. And, I will always get back to you. If I can answer questions, if I can help you, if you're stuck in a place, let's have a conversation. So
love it. Thanks again for the time, Mike. This was great.
You bet. Thank you. I appreciate it and hope this is great for your people.
Absolutely.